Ah,
Okay, hi everybody.
good evening
Good evening. Welcome to Two
or
Guys on
good
High Chair
morning
again,
or morning if
wherever you are.
depending on
Yeah.
where you are.
Okay. So anyway, welcome to Two Guys on High Chair again. This is our February update. So I think let's just do a very quick recap on what has been happening into the market, or what's happening in the market. So I think the latest news would be the last round of interest rates that have the interest rate hikes.
Okay.
Anand.
Yeah.
So we thought it would have been 0.5%, correct? But now instead it went to about 25 bips instead.
Correct.
Okay.
0.25.
Yeah. So do you think that the Feds have tapered off a bit too early this time?
I think so. And I think I I thought they tapered off too early, 0.25. I think there's a bit of market pressure. There was also quite a lot of chatter about soft landing in recession and all that. But when we saw the PMI results that came out in America and that inflation is actually generally still hot at the core, now everybody's also agreeing. They say, oh, maybe they cut off the 0.25 a little bit more. So I think what the market needs to understand and investors need to understand is we cannot and we should not predict where the terminal rate is going to be. And we've said this for almost 8 months or 6 months already, which everything is determinant on data. So the Fed's going to look at data and is going to decide. So since they have not cut their 0.25, they did not cut their they didn't do the 0.5 and then they cut the 0.25. They are all going to extend it further anyway.
Yes.
So we've been speaking to fund managers, and fund managers are saying that they have discounted a further 0.5.
Yes.
But now the market's looking at actually discounting in a 0.75 or even up 1% further rise from where we are at the moment. So that would take us to about 5.5 or about 5.5 or 5.75% in the US Fed rate. So I think it's very important to understand that how this works and choosing the next asset classes to basically deal with. So whatever it is, inflation is still hot. People are still spending.
Yeah, true.
China is opening and people are still spending. If energy has come off, then energy prices are probably going to go up if China is going to open up. So I think there is this little issue that we need to deal with. Ukraine is not going anywhere. It's still there. Yes, supply chain bottlenecks have improved, but I don't see costs coming down a lot.
Okay.
So I think from an inflation point of view, I think we're still there. It's still going to be a very choppy market. So that is why the November, December, the January rally, which we saw in the market, is tapering off at this point in time.
Yeah.
So it's coming off. So we've lost whatever,
gifts that have been
So whatever euphoria the market had in January, that's come off again. So now everyone is re-establishing what their lows and what things to be. So, however, it's generally agreed that US is not going to go into a recession.
Okay. Yeah. It's a contraction rather.
Correct. Yeah. For us, what we believe is there is going to be bigger contractions in certain sectors and not across the whole economy. So the whole economy is going to look good, but there are certain sectors that are going to contract quite a lot.
Okay.
So it's very, very important to understand where and how this happens. One of the most telling part is, for example, what's happening in tech at the moment.
Yes, exactly.
Yeah, so even within the tech industry right now, tech sector right now, we're having certain sectors that are outperforming the other sectors. So you're having NVIDIA doing very well because of the AI chip requirements. So you're getting stocks that are doing quite well. So you see, even within the tech sector, which previously everybody threw out because they were saying, oh, it's a growth sector and high interest rate will affect it. That's not happening at the moment.
Okay. So I think we were talking about, all right, 5.25, and that's what you think the terminal rate is, right?
Yep.
We've been speaking to a few fund houses since the beginning of the year, about 6 to 7, right?
Correct.
Now, what do you think will happen? Or it feels like to me that you're saying that, okay, they were saying like maybe around once we hit June, we'll have a better understanding with if the Feds do hit a terminal rate. At that point in time, do you see equities recovering?
All right, so let me reclassify. Terminal rate is where they say the Fed will stop raising rates.
Yes.
Okay, so
not cutting,
not cutting, stop.
Yeah,
so stop and pause.
Mm.
That means it will go to maybe 5.5% and stay at 5.5% until they see inflation coming out. No cutting yet. In fact, we don't think they'll be cutting until 2024, probably second or third quarter. Now, once that happens, I think the market will have certainty.
Yeah.
So once there is certainty, then I think analysts get to project earnings.
Yes.
However, once those rates hit terminal rate, companies need to see how that affects the demand of their products.
Yeah, true. Okay.
So that's going to affect the earnings in the next few quarters.
Yeah.
So usually analysts are later or slower to react to company earnings. Okay, until in situations like this, especially when there's been a sharp interest rate hike, the market's basically been in a situation where it's in flux. So it will take a longer time for the analysts to react. So I do think markets will be volatile for popular sectors, popular themes which we have seen in 2020 and 2021. So you're going to have volatility there. However, what's going to happen is you're going to have some consistency with the good blue chip. Sorry, I hate using, I'm sorry, I do not like to use the word blue chip, but everybody understands the term. The blue chip stocks, which means the good quality stocks with good value. So the value stocks, I think, will continue to do well. I think there is still quite a lot of premium in the value stocks in the market. So I don't like the word value. I don't like the word growth. I prefer to use companies that are run properly. So companies that are run properly with a consistent business model, good cash flow, they will do well.
Okay, cool.
All right. So I think investing in those companies will make a lot more sense.
Okay, great. So I think let's dive into today's main topic.
Yeah,
I think what we really want to talk about here is distressed portfolios. I think honestly, in the last 1 year, many people's investments, especially if they had started these investments probably at the tail end of 2021 or beginning part of 2022, they would have probably suffered quite a bit.
Actually, even right back to actually all of 2021. In fact, the last 2 quarters of 2020 also, we actually wiped out quite a lot of the returns since.
Especially if you're in China.
Correct. Yeah. If you're in China, you've been, everything is, even if you were heavily into tech.
Correct.
Your returns would have been wiped out if you started in early. If you started in June 2020, and you did not rebalance your portfolio, you would probably be losing your returns right now.
Yes. So, like I said, we are going to let's dwell into this particular topic whereby people, whereby clients, who have put money there and they have not seen the returns coming in over the last
3 years,
3 years, right? So, maybe let's start off with defining what a distressed portfolio is.
Okay, distressed portfolio is basically a portfolio that is not performing the way it's supposed to perform for you to reach your goals. Okay, when you start investing, when you tell your financial advisor, or when you speak to your advisor, you basically speak to your financial advisor and tell him your goals. Then your financial advisor will look at funds that basically would return or project, or which would return the percentage you want, say 6 or 7 or 8%. But usually that's backward looking. So that means the past performance, right? It's not forward looking, which is what we are trying to do here. So what happens is your portfolio is not going to be yielding that 6 or 7%. All right. So what happens in a market crash like what happened last year, and I don't think it's completed yet, but what happened last year? What happened last year, where you've lost about 15 to 20% of
Correct.
your portfolio.
Yeah.
And had you not rebalanced your portfolio, like what we recommended our clients to do to move into short-term duration bonds, you will basically have lost your initial goals of investing.
Okay.
So, for example, if you had invested $100 in June 2020, okay, you would have expected to get maybe $108 in June 2021.
Correct.
All right.
Yeah.
Ironically, you would probably by June 2021, the market was coming off. You would not be getting $108. You probably would have been getting $90.
$90. Yeah. Correct.
All right. So from $90, that $90 in June 2021 to June 2022, if it had gone correctly, you would probably get 8% of that $90. So it'll be $97.80.
Yeah.
But no, it fell further and you're now at $80. So you're missing out 2 points here. So the client basically was supposed to have $116.
Yeah, correct.
Because of his 8%.
Yes.
Is only getting $85. And they've lost that legway. So now that $85 needs to work harder.
Yes.
To reach the goals of that initial plan.
Right.
So what does a retail investor do? Our entire mindset is, I lost money.
Keep it there.
Keep it there for the long term.
Right. Things will recover.
Things will recover.
Yeah. Right.
But a distressed portfolio is these assets which were bought at the high because depending if they were not constructed properly, and if they were thematic funds like China A or just pure tech, and you've put 100% in just one fund, then you need to rebalance your portfolio.
Okay.
You need to rebalance your portfolio so the recovery is faster.
Yes.
Because these earlier funds will take longer to recover.
Okay.
So that's a distressed portfolio. The problem we have with a lot of retail investors is they are being advised to hold on to it because in the long run, it would be better.
Yeah.
And I think that is the wrong message out. A client should basically start looking at this distressed portfolio and reallocating it to the wrong place. I gave Gabriel an example the other day. If a child meets with an accident, I'm sorry, it's a bit morbid. If a child meets with an accident, you
need to tend to the child.
Need to tend to the child.
You can't just say, the child's going to grow up, it's going to heal.
In the long run, it's going to get better. So you need to tend to the child.
Yes.
And then if you find out there's bigger problems, you need to tend to the child. So treat your investments like children.
Okay. But the thing is this, right? I think the mindset of, I did had a little bit of kind of like an objection from clients where they will say, rebalancing the portfolio really just means that we're selling off the current position.
Correct.
Right? Aren't we making a loss from that?
You've already lost. The reality is you've already lost.
Okay. Correct.
So accepting the fact that the child had fallen down, is the first step.
Yes. Second
step is, do I take him to ER or I take him emergency room or do I take him to GP? That's what we need. That's what clients need to do. A decision-making process. I think quite a lot of clients say, I've only put very little money and they don't want to do. But what's really important is, has it affected your long-term goals? Do you still put money in the same fund?
Yeah.
Or can we do something better for you?
Yes.
So I think having that discussion with the financial advisor is very, very important.
Okay. So to realign these holdings, does it mean that we need to take on more risk then? Because I mean, look, if you're saying that, we're supposed to be at from $100 and then you're at 116, but right now we're at 85.
Correct.
So we need to that path to hit that 116 just means that we need to take on more risk.
Okay. Taking on more risk is not a bad thing if you know how to take the risk.
Okay.
Okay. So at the height of the market in 2020 and 2021, a lot of people were greedy.
Okay.
People were going for yield in actually risky assets.
Yeah.
Assets that, were risky.
Example,
Crypto, high yield bond funds. Okay. So, in Asia, so everybody was actually looking for high yield. However, where the market is at the moment, we are in a situation where we can take advantage of good bonds, for example, which are expected to yield 6 to 7 or 8%.
Yeah.
All right.
Yes.
So the first thing,
it's something which we have spoken to a lot of fund houses anyway. In fact, all 6 to 7 fund houses have been speaking agree that bonds are the way.
Bonds the way to go
this year.
This year, and we've already called that in our previous meeting. So, what's really, really important is we've got to make sure that we choose the right bonds.
Yeah.
Again, we're not going to go for riskier bonds. We're going to go for good bonds. That means good quality bonds, investment grade bonds that are yielding 7 to 8%.
Yes, correct.
And because everybody is going into those investment grade bonds and they were battered last year also, there is a possibility that the prices will go up also. So you have a double gain.
Right, the yields and the NAV capital itself.
Okay. So that's what we are looking at this point in time.
Okay. So so a distressed portfolio basically is monies which are already in. It's already been sunk.
You've already lost.
Yeah.
You've already lost your money and all that sort of stuff. Right. So if you have a regular savings plan, okay, where you're putting $100, $100 every month, don't think that you're going to put $100 back in that. Don't the mindset needs to change. The client needs to ask, okay, do I still put my money in my same fund?
Okay. So this begs the question, right? So what is good for the new monies? Okay, because considering that the valuations of a lot of the good stocks as well, okay, they have corrected since, like I said, over the last 2 to 3 years.
Correct.
And the bond market has also realigned.
Correct.
So what would you consider a good portfolio for people who want to invest new monies going in?
All right.
If besides a fixed deposit.
All right. Good. Yes. Okay. Good point. So you see, if you notice, when we first started Two Guys on a High Chair, we always said don't touch bonds because we knew interest rates were going to go up.
Yeah, correct.
Okay. Yes. We knew interest rates were going to say don't touch bonds because we knew interest rates were going to go up. We knew bonds were going to get affected. So we took you out of high yield bond fund. We took you out of quite a lot of bonds. We kept you in American high yield bond funds. They were affected, but this year they will recover. So we kept you in American high yield bond funds, but that was through Allianz Income and Growth, and that was probably only 40% of your portfolio.
Yeah.
All right. So what's going on right now is because we need to stabilize your portfolio in the first place. So that is why we're going back to strong equity, which probably won't be affected by interest rate hikes and market fluctuation, because they are already where they should be.
Okay.
And then the second thing is we are looking at sectors within the fixed income market, which have been cleaned up over this period that can give you the yields which you require. Okay. Remember, when we started speaking to you, when we started building portfolios for you, we said 6% or 7% is max. And this year, if you get it right, there's possibility of actually getting 8 to 9%.
Okay.
So there are two parts to your portfolio. One is your portfolio. One part of the portfolio is your capital. Remember the $100 and then the $97, $90, $96, $90, $92. Remember the example I was giving you up to 85. So that's your capital. And then the yield on top of that. You invest to get something back in return. All right. For FDs, for example, why are they only giving you 4%?
For 2 years?
Yes. Why are they only giving you 4%? You need to think why.
And where do they even get it?
4%, correct. Yes. They're getting better returns in short duration fixed income funds.
Yes, correct.
So they are getting 7 to 8% in Singapore dollar short duration bond funds, and they're shaving half and giving you 4%. But everybody's all very happy because they say, "Oh, it's stable." You can take a little bit of risk, okay? Because the NAV can fluctuate, but it won't fluctuate quite a lot. That's why we're choosing good bond funds for you.
Yeah.
Look, there are long-term goals. So the long-term goals would be taking a bit of risk. And
Okay.
the irony
True.
is the best time to take a risk is after a market correction.
Yes. But I do want to ask one question.
Check shoot.
Recently, I mean, yes, there's a market correction, but recently I was just reading an article from the Financial Times. They were saying that there's a possibility of a further correction with the fact that the interest rates have not been
Fully
has not reached its terminal stage.
Yeah, I think there is some truth to it. So that is why we're very cautious with our equity allocation.
Okay.
We are not looking at thematic funds. When we're speaking at our fund managers, we're looking at only stocks that can withstand a shock.
Yes.
All right. Number two, the increments of the Fed right now is small. They're 0.25.
Correct.
So they don't affect the effect on the longer duration funds is now minimal already. Okay, because it's slow.
Yes.
Not like what happened last year where it was
huge.
the 3-4% jump. That basically shocked all the long dated bonds. I mean the bonds with 10 years or 20 years or 30 years. So that's why we ask you to buy short duration bonds like the UOB Singapore short duration bond fund. So that's why we did that switch.
Right.
So right now, when we're speaking to the fund managers, we've realized that they've shortened their durations and they're looking to increase their duration in some of the long data. Duration means sensitivity to interest rate hikes. So a lower duration means
less sensitive.
Less sensitive. That means less effect on the NAV of the fund. So the funds we are recommending you this time around, the duration ranges from 0.15 to about 4.5, 6 or 4.6. Okay, so the duration is
4.6. What, years?
Yeah,
Months?
yes. Yeah, but it's the sensitivity. It's less sensitive to interest rate hike, but they are expected to yield between 6 and 9% per annum.
Yeah. Yesterday we were speaking to Wellington. Their bond papers were looking for 4 years. They're looking at about 8%.
8%. Yes. So there is possibility for you to earn these kind of returns, but we need to be decisive. We need to move fast, because by the time everybody else gets on board, it'll be June, July, and then the terminal rate would have been stabilized, and the fund, all the pricing
has already gone in.
Yeah. So you only will be getting it from the yield, and your capital will basically not increase. So that is why we're rebalancing the portfolios actively this next couple of months.
Okay, cool. So so I think at this point in time, what would you recommend? I mean, for like the new markets, new monies that are. So sorry, let me just rephrase that. So what would you recommend for distressed portfolios now? Now, I caveat this down. This is what I'm saying. The monies that are already in the market at this point in time, and they have already suffered losses. What would you recommend for these monies?
All right. The first thing to do is actually identifying what you have. The issue with a lot of retail investors is they don't know what they have.
Yeah.
They leave it completely to the financial advisors that they don't even know what they have. Identifying what you have, understanding why it underperformed or why it has come off, and understanding if it will do well. Okay. Number two, you have to see how much money you have. So if you have saved up $50,000 and it's $25,000, then you are in a better position to do something. But if you've gone up to $5,000 and it's $2,500, then it is best that you completely change your portfolio. So these are considerations you need to take. But the client you as a client need to understand these things.
Yes.
All right. However, I would suggest to look at different asset classes. This is either the time to re-diversify, or it's time to liquidate and go into something better. So these are things which we need to look at. See, for example, China.
Yeah.
We are pro-China. We really like the China story.
Yes, we are.
But we do not like the broad China story. And we're speaking to a lot of fund managers, and we're trying to get you funds that are
onshore,
onshore,
on
the ground,
stock pickers,
stock
basically.
pickers,
Yeah,
correct. Fund
funds, yeah.
managers with people on the ground and know which companies to buy.
Yeah.
So we're not looking for the broad China A's. We're not looking for people that buy off the index.
Right.
So when we're recommending you funds, we're recommending you funds with fund managers that know what stocks to buy.
Correct. So I mean, just an example. I'm not going to name which fund house that does this, but one of the fund house that we spoke to, they don't just specifically. Okay, I mean, yes, now we have this EV vehicles evolution, right?
Correct.
But this particular fund house don't buy into the EVs directly at all.
Not like Warren Buffett.
Yeah, correct. So they buy actually into the raw materials like copper, the things that make the battery of the cars and so on. So I think these are the fund houses that we actually want to work with, because they're really on the ground and they're investing and they're buying good stuff.
So things are really different. So everybody also needs to understand China is becoming expensive to do work with.
Yes.
Restrictions in America, even Japan. If you read Kyocera, it's basically already said that it's no longer cheap to produce material in China. They've gone back to Japan. So you see, there is quite a bit of a realignment going on at the moment. So we need to understand which part of the Chinese industry that basically will support China. And this is why it's very important to choose fund managers which are stock pickers, bottom up, and will be able to choose the correct stocks in their funds.
Okay. All right. So I think we have a bit more time for our last question.
Shoot.
Now, I think we would also have questions whereby, okay, so let's say for example, right, okay, we have these funds that the fund has really lost.
All right.
Right. 20%, 15 to 20%, let's say, or maybe some even 30%. Does this mean that since these funds are already in distress and the value has really been devalued really by that much, technically speaking, it's an opportunity to put more money in this fund.
Okay.
For future returns.
Okay. The assumption that if you initially bought a good fund that has been wrongly classified in the sell down, in the sell down. Like tech stocks, for example. If you bought a good tech fund, then the fund manager basically has got good tech stocks inside. That tech fund would be recovering.
Fair enough.
They would be doing well.
For example,
NVIDIA or applied materials, Maxell. Okay. Yeah. Those will be doing well. Okay. However, if a fund manager who's like Katie Woods and ARK, which are still very ultra growth on the other end, they are not going to do well. So you've put money in there. You need to take it out. You need to take it out and realign. So you need to choose a fund manager, and this is what we do for you. We try very, very hard all the time. This is why we're speaking to fund managers all the time, to see a fund manager that's able to basically liquidate or realign for you.
Yeah.
So you need to speak to the financial advisor. The thing is, because everybody is doing regular savings plans, they tend to forget that they're actually investing. They say, "Oh, I'm just putting a little bit, so I'm not worried about it." But everyone needs to be efficient in this environment, especially in an inflationary environment. And like what we've always told our clients, you got to make sure of your spending in this environment. So we never know. We could lose jobs, and at this point, and we're not at the end of the whole cycle.
Yeah. Okay. So I think we've come to the end for today.
Yep.
It's really good updates, I guess. It's something I guess that, like I said, a lot of people probably are a little bit lost in terms of where they should be investing their money. Should I start now? Fixed deposits are good, maybe I should put my money in there. So I think this is informative, right?
Yeah, it's also very good for clients, for you all to basically, if for the funds not managed by us, if you've got funds anywhere else,
and if you need help,
yes. You need to get in touch with us, because we need to know exactly how you're doing and how we can help you in that sense. So as Gabriel and I are specializing in revitalizing distressed portfolios, we're seeing a lot of examples where people basically don't know where and how and what they're putting. So when we realign the portfolios for them, when we bring you into the process, I think it's very, very important for clients to basically understand that they cannot run away from understanding what's going on in the markets at this point in time. So do give us a call.
Yes.
If you need any help.
All right. Okay, so that's all we have for the February edition. So
we'll see you in March.
Yeah, we'll catch up again.
All right.
See
Thank you.
everyone. Bye-bye.
Bye. Bye-bye.